Hello, happy Friday. I did a video yesterday, but apparently there were some problems with internet issues late in the evening, and for whatever reason, it didn't go out. So you actually have two videos in today's email link. Yesterday's appropriately marked, and then of course this morning's. Today's just going to be super brief because it's a follow-up to yesterday. Conversation yesterday was that we had gotten enough data points to show going from a quad 4 deflationary event to a quad 3 stagflationary event. And the biggest call outs with respect to the differences of those two elements are quad 4 no tech exposure, quad 3 tech exposure, dependent upon the movement of the volatility measurements of those elements. The NASDAQ volatility measurement, VXN, is still in a bucket that we would coin a very cautious regime. In other words, you can get some big movements very quickly if you're on the wrong side of that volatility measurement. So what we try to do with regards to VXN is when buying NASDAQ positions or technology or growth-oriented positions that have a NASDAQ exposure, we want to buy when VXN is up around 37. We want to lessen our exposure, sell some down when it's VXN in a 34 range, 33 range, and just kind of pay attention to what we call that chop. Same thing with VIX that controls basically most everything else in terms of equity space here in the U.S. That's the S&P 500 volatility measurement. We want to buy up towards 30. We want to sell or at least lessen some of the exposure load down towards 24. The bigger issue with regards to today as a follow-up from yesterday is the interest rate cycle. So the first chart I'm going to show you is a chart of the 10-year Treasury. I showed you one yesterday, and it showed interest rates having gone up for 6 days in a row, which is pretty rare. We don't typically see those kinds of movements that quickly. But, you know, every now and then it happens, and it's the market trying to sniff out, now what? Basically, when you think of the volatility measurements of the Treasury market, we have to look at something called the MOVE, M-O-V-E. And it broke above 60 a few days ago. 60 is a bad area. It's not a good place for volatility of Treasury to be. And the Fed doesn't like that. When they see the move above 60, they don't usually wait around too long before they start basically sending some of their balance sheet into the Treasury bond market. So our Treasury bonds that we had purchased, we started buying and getting bigger in those positions towards the end of September, and I'll show you those interest rate spikes and why we did that in a moment. But the decision to hold on to them through this cycle of interest rate movement here recently has been a function more of what we've seen in the Treasury bond volatility market, the MOVE index, more than anything. It broke above 60 for one day. It broke back down below 60, but not by much. Anything above 56 is an area that just causes me to be not super excited about it. But at the same time, interest rates keep hitting, kind of tapping that top level of the mathematical range each day. And when you see that, and then also compare it to the options market. So there's things that we watch called implied volatility premiums and discounts. When a really, really big implied volatility premium develops in any one asset class, what that tells us is that it increases our conviction for bullish exposure. A discount is the opposite. It causes me to be very concerned for that position and increase conviction on either selling that position or shorting it, anticipating that it, in fact, will drop. So a couple of things with regards to that. The interest rate top end this morning was 0.88 on the 10-year Treasury. And why don't I just show you a chart here so you can see. So I'll just zoom in for you. The top of the 10-year Treasury today, before market open, was 0.88%. We've hit a high today of 0.865%, and then it reversed. And of course, nobody knows exactly the reason why, in fact, a market may or may not reverse. And I don't really care about the why. What I care about is whether or not the math is suggesting that I should do one thing over another. Should I buy, hold, or sell? And to this point, when you have 6 days in a row of a rising interest rate market, all of which were at or above the top end of the mathematical calculations for the day, that's sort of rare. And we saw the exact same thing happen in June. So let me go back to that chart. Back in June, you can see we had this real quick interest rate spike. Everyone chased it, got on the wrong side of it, and the whole thing then just fell apart. And back in June, what was interesting is that the same sort of scenario as a fairly large implied volatility premium developed. And right now, there's an 87% implied volatility premium. Now, I know that that doesn't necessarily mean a whole lot to many of you listening right now. But when we start seeing implied volatility premiums ramping up above 40, 50, 60, in this case 87%, that's a big number that for me suggests more bullishness than bearishness in terms of bond price. But we take that into consideration with other things too. The move came back down below 60. Hopefully today, because we only get the move index based on close, so we get it about 5 to 10 minutes prior to the market's close. Sometimes it's a little late and they send it to us after the close, which never makes me happy. But nevertheless, it's towards the end of the day. I'm hoping that that move index will continue to come down. My anticipation is that when you see an interest rate bump like what we've seen now, similar to what we saw at the end of August, at the end of September, and of course back in June when things really ripped, the Fed does not like that. They do not want to see interest rates go up and potentially hurt the opportunities that they have in terms of keeping interest rates low for economic growth. So is it possible that the Fed could come in and start rebuying the Treasury market? It's possible. So the things that are going for the positives of holding the bonds through this little bit of a downturn due to interest rates having gone up was that interest rates have gone up a lot in a very short period of time, very consistent and similar to what we saw in June. The MOVE index has now moved below 60, but it's above 56. I want to see it get below 56 for me to be really excited about holding them. We did see a reversal in interest rates so far today. Hopefully that will continue. Some of it is, of course, dependent upon on the dollar and what it's doing. The dollar hit the low end of the range today, and now it's slowly creeping a little bit higher. On top of that, we have these very large implied volatility premiums versus a discount, which again is very bullish. And on top of that, consensus is very net short of U.S. Treasury bonds. Now, what that means is they expect prices to drop. What we always attempt to do is get on the opposite side of what consensus is doing, because in most cases, consensus ends up being wrong. And we're looking at some of the biggest net short positions in CFTC futures and options contracts that we've seen in close to 3 years. So they're heavily net short, and we know it. We like to be on the opposite side of that. You just kind of add all these things up, and as you add them all up, you put them in a positive negative column, and you ask yourself, do I have more positives than negatives? And if so, then that will help me to hold that through that process. One more look real quick. If interest rates get back down around to this 0.7% range, which is down in this area here, if we see interest rates come down to this 0.7% range, then what I would be doing based on the current market stance is liquidating the Treasury holdings that we've got. And I would anticipate a move in interest rates like that could cause for those positions to not only increase their price, but of course put a profit in the holdings that we've got. And the reason I would be doing that is that the market is now sniffing out whether or not in Q1 of next year we move into a Quad 2 environment, which is a growth with inflation. Now, so far, earnings are terrible. I mean, it's just straight up, they're just garbage. But that being said, the machine may look at it as, okay, it's as bad as it's going to get, and so therefore we have to start thinking about where the puck's going to move next. And so does the puck move into another quadrant that gives us more economic growth? Currently, the yield curve says yes. The yield curve steepened today to 70.20 basis points. The day before it was at 67.54. The day before that it was at 64.26. Day before that it was at 62.35. Day before that it was at 60.25. You get the point. The yield curve is steepening, and when the yield curve steepens, what that does is it suggests economic growth is coming, and the market is preparing itself for it. So we know we've moved away from quad 4, and so therefore we've taken off the quad 4 structure that it was in place. Treasuries work in both 3 and 4. They don't work very well in 2. Quad 2, that is. So that's why with an interest rate drop to 0.7%, I'd unwind the treasuries, move more towards a growth-oriented perspective dependent upon what VIX and VXN are doing. If it stays in that chop zone, so for VIX, it's 24 to 30. For VXN, it's between 34 and 37. If it stays in those zones, then we'll just be more active with the positions that we hold in terms of buying and then selling some based on the movement of that volatility measurement. But I'd be unwinding the treasuries at 0.7% 10-year treasuries or close to that point in yield in anticipation of the market sniffing out a Q1 quad 2 growth with inflation type of an environment. So we anticipate that the dollar continues to remain in a bear market. We think oil moves to a bull market. It's not done that yet, but it's close to breaking bullish trend, and that's that will be bad for those of us buying gas at a gas pump, good for those of us that can buy positions in a portfolio that are oil focused. Within that lens, then we'll continue to pay attention to the interest rate cycle and how it's affecting things. But treasuries don't work great in quad 2, which is why I'd be taking them down at that point. So anyway, just a real quick follow-up. Wanted to let you know exactly how things are developing as the day progresses here. If you have any questions at all, of course, as always, please give me a call. Direct line 608-354-1977. Email chris@careformywealth.com. Hopefully these things are helpful for you just to get a glimpse into what I'm doing and why I'm doing it. And, I have access to and have conversations with from time to time some pretty big fund manager companies throughout the sphere of this industry. And I had a conference call this morning with one in particular, and one of the things that stuck out to me was that our current net performance is better than what theirs is. Now, again, not to try and compare apples and oranges because they do things a little bit differently, but at the same time, it's always good to get a glimpse into what the other big operations are doing. Not everyone has 100% exposure to the NASDAQ or NASDAQ-like names from March 23rd. I know a lot of people would like you to believe that, yep, they picked the bottom and they've been levered along this whole cycle. But that's not how it works. We're not worried about trying to pick a bottom. We're worried about focusing on risk management, focusing on the development of the portfolio this week, this month, this quarter, and getting the trends right. Trends are 3 months or more. So we want to get the trend right. Within that process, we want to get the trade right. Trade are 3 weeks or less, basically. So if we can get the early stuff correct and let it develop into that trend process, that'll just help the portfolio over time. And so as these phase transitions in the economic sine curve continue to get pulled back and forth, and there's that tug of war that's gone on, we're just going to trade around those core positions that work within both a 3 or 4 environment with the process, the lean, the direction towards a more bullish stance on the equity space because of the possibility of the market moving towards a quad 2 growth with inflation type cycle come into mid Q1 next year. So we'll see how it develops. As always, when the data shifts and the data changes, we make adjustments. And if it continues to shift and change to the point where it requires big changes in portfolio structure to protect your wealth, then please know that that's exactly what I'm going to do. So if you'd like to have a more detailed chat on this or anything else that I've talked about today or yesterday, and again, I apologize for the distribution problems on yesterday's email, but that's technology, I guess. So thanks again for your time. Always thankful to work for you. We are so appreciative for that opportunity and continue to wish you the best. Hope you have an awesome weekend. God bless. Talk to you soon.